Hello and welcome. WhiteOak Capital has built a reputation for delivering standout performance with their equity funds often sitting in the top quartile. But what really drives this edge and how are they positioning in a market where small and mid-cap valuations are stretched? To answer that and much more, we're joined by Ramesh Mantri. He's CIO at WhiteOak Capital Mutual Fund. Welcome, Ramesh.
Thank you, Ruchira.
Now, to begin with, Indian markets, they've held up well despite tariffs, inflation worries, and global uncertainty. So, do you see that resilience lasting, or are investors underestimating some risks here?
Yeah, one, it's always nearly impossible to predict what markets will do in 6 to 12 months. Invariably, the short-term market movement is defined by events that you can't predict. Expected events don't move markets in the near term. In the longer term, the only thing that matters is basically, long-term corporate cash flow growth. That is what finally, which is linked to how well the economy does, fundamentally, very long term. So that's what matters. Near term, it's very impossible to predict. I think considering the slowdown in India, considering the geopolitical situation, considering the current situation on tariffs with 50% tariff, I think Indian markets have held up quite well.
So now, mid cap and small caps are still priced above the large cap even after the bouts of corrections. Do you think this gap is justified given the earnings outlook of the mid and small cap segment?
Yeah, so one, clearly when we look at long-term valuations, even today, small cap, mid cap valuations are at least 20% premium to large caps. And normally environments of uncertainty and volatility and slowdown are more tends to impact adversely smaller companies more than larger companies. So as you can see in the last 12 months, large caps have outperformed small and mid. So is exactly what's playing out. Of course, the difference gap in performance is not very stark. One of the big reasons, of course, is that we continue to see very strong flows on small cap and mid cap funds. And many of that flows are linked to SIP books, which by definition are a lot more resilient.
What do you expect going forward? Will this gap narrow? Will we see the mid cap and small cap, staying at the similar level? How do you look at it?
Well, it's very difficult to predict what happens, right? But longer term, see, if small and mid cap can sustainably grow faster, then sometimes those premiums can be justified. One thing we have to understand is we are going through an economic transformation in some ways towards manufacturing with certain parts of the manufacturing economy, let's say on uh, the EMS side, on the pharma side, on precision manufacturing doing well. And those companies are all represented in the small and mid. They are not represented in the large. So the advantage of a small or mid cap sector is they tend to represent the early sectors, emerging sectors, fast growing sectors, and fast growing companies. So that tailwind is often there, particularly when economic transformation is happening.
Right. So, as you mentioned, flows into mid and small caps, they remain strong, but earnings haven't really kept pace. So, how do you separate fundamentally solid businesses from those just lifted by liquidity?
Yeah, so one, when we're talking at aggregate valuations, it's not that everything is expensive. At the end of the day, when we always talk about aggregates, it's all at a collective level, not about individual companies. Because the small and mid cap is a very large universe, while of course mid cap by definition is only 150 companies, but the small cap is any company with, 250 first market cap and onwards. So it's a very large universe. And please mind, note that you're seeing now maybe two IPOs a week in this space. So there is also a constant growth in supply. So within that, you are going to see always quality companies emerge where growth is attractive with respect to valuations. So not everything, please understand the difference when you talk of collectives, aggregates, and individual companies. So I think for a bottom-up investor, people are willing to invest in research. I think there are a lot of attractive opportunities in small and mid.
So now in our earlier conversation, you mentioned that WhiteOak's AUM strength and the depth of the investment teams allow you to go further down the market cap curve, spotting the promising companies at the early stage. Sir, could you just help us understand roughly how many companies make up your potential investment universe under the active coverage?
So the team, the collective team, tends to track about 1,000 companies. Not that we look to invest in them, but we want to have a coverage where we at least look at 1,000 companies. Typically, companies with about 1,000 crore of market cap, we tend to look at them. And in fact, we have even invested in companies with much lower market than cap than even 1,000 crores, even in the mutual fund portfolio. So we have, I would believe, one of the highest active coverages of stocks in the market, right? Of course, you spend different amount of time based on whether you are invested in the company, you really like the opportunity, or something that you want to keep a track of.
Okay, so minimum is ballpark number is around 1,000 crores or so.
Yes, that is the starting point. But I just want to call out,
Yeah.
we're already, as we speak, invested in number of companies below that market cap also.
And sir, what role does the momentum play in your stock selection?
No, see, we are not quant investors. Let's be clear. We are fundamental bottom-up investors. So we are not looking at price momentum. Of course, as fundamental investors, everybody would like to see businesses doing well. That is how you create value, through growth in a market like India. So that's what we are focused on.
Right. So you often advocated that a well-diversified portfolio with a large number of stocks is more reliable strategy for consistent performance. So while your sectoral and thematic funds, they naturally display high concentration, your diversified offerings like the Flexi Cap, Mid-Cap, and the multi-asset fund, they often carry portfolios of more than 100 stocks. So is that scale of diversification easier today because your funds are still relatively smaller?
No, so actually, our objective is to allocate capital to opportunities where we believe we can generate the highest number of alpha per unit of capital deployed. Now, what happens often in smaller companies, let's say if you find a great small company with, let's say, 1,000 crore market cap, even if we want, we cannot deploy more capital. So we get constrained. But I'm happy to even take a 25 bips position in a small company that I believe will significantly outperform the market, then go with the default of putting that money in a large cap stock. So the large number of companies we have is not because we want to diversify, is actually to optimize the alpha, to maximize the alpha in the portfolio. In the process, you end up having so many names because a lot of those names I wish I could put a lot more money in, but neither can we nor any other fund manager can put more money. It's because of the size of those companies. So the diversification benefit is a secondary benefit. That is not even the objective of those number of positions in the portfolio. The objective is because you have a large team, you are able to go down the market cap, identify opportunities early, and you want to extract the most amount of alpha from those positions.
Right. And how do you ensure that each stock in such a large portfolio still carries conviction and adds meaningfully to performance?
No, first of all, I think meaningfully has to be relative to the capital you deploy. Let's say, I'll give example, right? If you deploy only 0.5% in a portfolio and the stock is like a 4x, 5x, we had haven't in last 1 year stocks which are a 4x, in that kind of, even in this kind of market cap, but in this kind of market environment. So that itself can create 100 basis points of alpha, one single 0.5% of position. So that is significant. Remember, consider how much total alpha a fund will generate. If a 0.5% position can generate 1% alpha to the fund, I think you all need is two such picks in a year, to make the real, that could be the real, cream on the top of the cake, right? So, and conviction comes not because the single biggest risk we are able to go to such large number of names is the significant investment we have done in research. So we believe typically an analyst, right, can cover 20-25 stocks. So if you're a small team, it's very natural you run concentrated portfolios because you can cover less number of stocks. But if you have the kind of team, that WhiteOak has, which is one of the most resourced team in the industry in India, you can go down, you can cover a large number of stocks. So while for that analyst, it's a high conviction position. Please understand for that, see a single analyst out would only be covering three, four stocks of that portfolio. So for that stock analyst, the team that is there, it's a very high conviction position.
Sir, you mentioned about the uh, minimum threshold of around 1,000 crores, and in some cases you have got below the 1,000 crores also. So what's the exit strategy in some of these names, which are typically micro cap or small cap kind of thing? When do you
See,
exit these positions?
See, ideally, when you invest in companies as a long-term investor, you never want to exit them, right? You want to believe these companies can grow for a long period. And anyway, these companies are small, so size is usually not a constraint. But in the real world, things don't work out. First, things go wrong. Things go wrong for, let's say, broadly two reasons. The first set of reason is when externally something happens, a COVID happens, a tariff happens, when companies or can't do much about it. But sometimes those actions can materially change the trajectory of a business. You can't help it. Suddenly, let's say if the current tariff regime remains, if you're a garmenting company selling to US, hard luck. I hope that tariffs will change. I'm an optimistic person. But that suddenly changes the economics in the business. So you have to take those decisions. The other kind of mistake that happens is the environment may not be bad, but the company is not executing to its potential. That's also another reason for you to reallocate that capital to other opportunities. Because remember, you have to constantly optimize the return you can get on your capital. So if some company is not delivering to its potential, then you need to, reallocate the capital. But the best out, and then the third outcome when you reallocate your capital is you get lucky. The stock does much better than your, I'm not saying the business, the stock does much better than your expectation. And suddenly you realize that, let's say you thought a stock will be 3x in, let's say 2x in 3 years. And in 6 months, the stock doubles. Now, what do you do? Because it's possible for the next 2.5 years, you may not make any money in that stock. So it's best to reallocate that capital.
Now, sir, we look at some of the portfolios of the fund, and despite having a large number of holdings, the top 10 stocks made up approximately around 30-35% of the portfolio. Could you shed more light on this granular risk-taking approach?
Yes, so one of the things, our approach is that, the way we think about portfolio construction is that performance should come from stock selection, neither from style factor. Style is like value manager or a growth manager. It should not come too much from a market cap category. For example, in a flexi cap, you're entirely small or mid or entirely large, or it comes from sector bets where you take a very large concentrated bet on two three sectors and those sectors do well, you do well, or you take very large bets on single stocks. So we have very defined risk framework for all of these factors, whether it is market cap, sector, style, including single positions. So we want to cap the active risk we take, for each of these factors to a level where it's manageable, so that a single stock, single sector, or a single, factor, style factor in the market does not explain a large portion of our returns. So see, for example, we define an active risk. So typically, let us say if it's a large cap stock, I will not take more than 4% or 5% active risk on the position. So versus of 4-5%. Similarly, I have a defined active. Now that limit will be lower for mid cap. The limit will still be lower for a small cap. Because remember, the risk goes up. When things go wrong in small cap, it's hard to exit. In a large cap, generally exiting is not a challenge, right? So that's why the risk limits are different. Similarly, you have risk limits defined on sectors and industries. For example, if you think of a sector, think of BFSI as a sector. So let's say the what you call the benchmark has 30% weight in the BFSI sector. Then you will say I will neither be below 20 or above 40, 10% variance on either side. Then within BFSI, there are industries. Like you can define capital markets as one industry. You can define insurance as one industry. There also you're very clear that while the sector limit is 10, the industry limit will be, let's say, 7.5. That whatever is there, you will not take active risk more than that. So that a single factor does not overwhelm your portfolio. It will have impact, but it does not completely overvalue your portfolio that you did well only because of this reason, or you did poorly because of only this reason. The performance should come from stock picking. That is the whole objective.
Right now, so moving on to some fund-specific questions. So, WhiteOak funds are consistently in the top quartile across categories. So, beyond disciplined stock picking, what else has helped sustain this performance? If you can elaborate on that.
Yeah, so one, see, we started the mutual fund 3 years ago. I would say the first 21 months till June 2024, I would say in a sports parlance, it was a flat pitch, a very good environment for risk taking. And as you can give a cricket analogy, if the pitch is flat, the right strategy is to be aggressive, go in the front foot and try to hit the ball for a six. In the last, let's say, 15 months since the elections in June 24, the pitch is no longer flat. In cricket parlance, now the pitch has started turning. The skill required to play the game is very different versus the skill required to play on a flat pitch. I'm not saying the pitch has become very dangerous. I'm not saying that. And now today, a balanced risk reward matters in the portfolio. I think in those first 21 months, the more risk you took, the better was your fund. So small caps outperformed mid caps outperformed large caps, cyclical sectors did well, micro caps outperformed small caps, right? Now it's a turning pitch. Not everything is doing well. Some things are doing very well. So for an active stock picker, this is really the environment, where you actually add a lot of value because now balance risk taking works. So for a bottom up fund manager who's invested a lot in research, this is the kind of environment that works very well. So we did outperform, let's say, our Flexi Cap fund, which has completed 3 years in the upcycle on those 21 months. But in the phase where volatility has emerged, we of course can show you that our processes work.
So, but as you mentioned, the flexi cap and the large cap, which did very well in the last 1 year, but in the YTD, it's been in the third quartile. So, is it more due to the weak market conditions or any stock specific call which went wrong?
No, so again, see, it is nothing to do with too much of stock picking. It is like you will always have periods, short periods where every fund scheme will have its phases, right? Clearly, we are by definition overweight small and mid in our flexi cap. And in this year, as you can see in this calendar year, there is small caps and mid caps are underperforming large caps. So I said, right, while we take the balance, it's not zero. So we are getting slightly impacted by that factor. But I would not focus too much on year to date. This is too a short period for a fund manager to think of performance.
So, as of now, sir, you continue to remain positive on the small and mid cap segment.
No, it's not about positive. It's our ability to, extract alpha out of that small and mid. That is I'm very confident about.
Right. Moving on to your mid-cap fund, we quite like the way your mid-cap fund has shaped up, and especially considering how it has navigated both the ups and downs of the market in such a short span of time. So, could you take us through how you construct and manage a portfolio that currently runs into more than 100 stocks?
Yes, so first of all, as you are aware, the mid-cap universe is 150 stocks, and you have to have minimum 65% exposure to out of that basket. We typically target a 70% number, normally out of the mid-cap basket. And then the way we run the mid-cap fund is we don't typically buy large caps, big large caps in that portfolio. In fact, the large caps that you see in a part cap in our mid-cap fund were mid-caps not long ago. Those are mid caps that have graduated to become large caps. And every 6 months, some mid caps become large caps, some large caps become mid caps. So that position keeps shifting. So typically, a portfolio of large caps is actually the portion that has graduated from mid caps to large caps. In fact, we have a lot of a portfolio invested in the small cap portion, of which number of stocks we expect them to graduate into mid cap. the future mid caps, right? So our portfolio tends to be more mid cap plus small caps. That is our structure of our portfolio. This is what we always explain. This is what we want to do. Today's mid caps and hopefully future mid cap, which are today's small caps. That is what it is. We like to be diversified. So if you look at our exposure versus sectors, you'll see presence across sectors. There are no big sector calls in our portfolio. We are overweight as we speak, financials and IT. This is because in the mid cap basket, we are finding more opportunities there as we speak. We will see us underweight consumer because we like less the consumer opportunities within the mid cap space today. So it is more bottom up where we find the opportunities. We have run a low beta fund on the mid cap side. So in fact, when there was a strong rally in the mid cap, and because we were running a low beta mid cap fund, we actually, because the low beta, you tend to trail the market because you don't get benefit from the full market movement. But that is how we want to run this fund, slightly much lower beta than the market, but deliver strong and consistent performance. And the reason why we want to run lower beta on mid cap is mid cap by definition is volatile. And if you bring the beta down, you actually reduce the volatility experience for the clients. And the second thing, the most important thing, design of a fund is since day one, it's always been an SIP only fund. Because of that, we get very regular flows, practically flows every day into the fund. Even if you have a slight redemption, the inflows pay out of that. So you have investors who are invested in the fund largely through SIPs. They have a long-term orientation. We exactly know every month how much money inflow we're going to get into the fund, and so we can plan the deployment. So it's a product structure that creates win-win for the investor and for the investing team.
Now, sir, if you look at the mid-cap fund, the portfolio turnover is fairly high compared to the peers. It's around 200% by the AMC's own disclosure. This suggests that a strict buy and hold policy may not be, your style. Would you agree with this point?
Chirag, there are two technical reasons why the turnover looks very high. It's actually not this kind of turnover, but we have to report that 200%. I'll tell you what happens. First is that we tend to move our position between cash and futures. So let us say I own the stock and suddenly the futures start trading at discount for whatever reason, and I'm a long-term investor. So it's better for me to shift that money from a cash position to futures. And then when futures go back to premium, we go back to cash, right? So we constantly move those positions between cash and futures, which by the way, cause turnover on both sides. You are selling the cash, buying the future. So there's turnover, double counting of turnover. And by the way, this is the fundamental underlying position has not changed at all. Remember, that's the first point. That's a huge reason why you see these elevated numbers, right? This is not the underlying. We don't have a trading mindset within the portfolio, just to give you a context. Second is we are fully invested all the time. So let us say if I have to add a new position, I have to sell something. For people who are fully invested, remember you always have to sell something to buy something new. Like for example, there's recently a big policy move on the GST rate cuts. That may look as to rethink some of our exposures in the chain, right? Now that will require us to sell some existing positions to buy. That itself creates turnover.
So basically, it's nothing to do with the portfolio. Means, it's not a high churn portfolio kind of thing. It's
Yes,
basically to do with the FNO only.
yes. So actually, the actual real turnover is much, much lower than what is reported there. It's because of the cash and futures arbitrage, a large part of turnover is created in the fund.
Right. Now, your multi-cap and flexi-cap schemes, they remain overweight in small caps relative to the category. So is this also driven by valuation opportunities, or is it earnings visibility or simply a bottom-up outcome?
Yes, so it has nothing to do with our views on what happens to the small caps in aggregate. It's simply because we believe as a team, we have much better ability to create alpha in small caps versus large caps. So if you think you can do much better in small caps versus large cap over a long period, doesn't tell you what to do in a year. If you believe you can create a lot more alpha, that is why we are overweight small caps versus our peers. It has nothing to do with our view on valuations. And secondly, the universe of small cap is very large. And as I said, we are one of the deepest coverage of market. So we are able to invest in number of positions uh, because of the investment and research.
And sir, lastly, despite the weak IT performance over the past 18 months or so, several funds of the WhiteOak has continued to remain overweight in this sector. What gives you confidence in this positioning?
Yes. So first core philosophy I want to call out is we don't take top-down sector calls. So if you are going to zero in IT, or then means either you have taken a very bearish call on the global or US economy, or maybe a very bearish call because of AI. We don't tend to take those kind of top-down calls. As I said, we maintain very tight sector balances, sector limits versus the benchmark, right? So first, that's the clear framework. Secondly, if you see our portfolios very carefully, uh, we typically tend to be overweight small and mid versus large. See, IT industry actually has mega caps, but if you see our portfolio carefully, you'll see a lot of small and mid caps in our portfolios. And that portion has outperformed the large caps. In fact, the last 3 years, uh, IT actually has created one of the highest alphas in our portfolio versus the benchmark, our IT portfolio. So, in fact, when a sector does not do well, that is actually the best time, greatest time to create alpha because not enough people are looking at that sector. And
Right.
I am not bearish on Indian IT. I believe, India has gone through various cycles, technology cycles change. We had a period where cloud got adopted, digital came in. A lot of people wrote death sentences on the Indian IT industry, but Indian IT industry came back. I'm very optimistic. We Indians will learn and evolve. Already the world's largest talent pool of AI professionals are India. We'll find a way. It will take some pain, but IT should come back.
Sir, lastly, any particular sectors you are bullish, specifically in the mid and small cap segments?
So we are generally not top-down investors.
Mhm.
We are bottom-up investors. If you ask me in the small and mid-cap space, let me call out, let's say, sub-segments of the space where we are seeing good growth and valuations are attractive. First, let me call out the space affordable housing within financials. I think capital markets, the long-term growth story is very attractive. There are also a number of opportunities on asset, wealth management, and related spaces within the capital markets bucket. That's on financials. On pharma healthcare, I think it's entirely a bottom-up sector, so there are opportunities on both domestic formulations and also on CDMO spaces, and of course on the healthcare side in small cap healthcare stocks. I'm very bullish on the consumer on two spaces. One on the travel space, where we are finding a number of opportunities, and also the new age businesses on consumer, where now companies have figured out how to make money, unlike the loss-making companies of the past. There are then, let's say, if I put something even like real estate, we are pretty bullish on, let's say, the new space like flexi and co-working spaces. It's a very small space of the market. Then coming to manufacturing, I would say we like number of opportunities on high precision manufacturing, not mass manufacturing. Manufacturing for high-end auto components, industrial components, aerospace, defense, where it's a combination of engineering and labor rather than just pure labor arbitrage.
All right. Well, with that, time for us to wrap up this chat. Thank you so much for joining in and sharing your insights.
Thank you, team.